How do you make that decision whether to fix or go variable?
There literally is no downside to reserving a deal early. It can save you a lot of money.
Welcome to today's episode. I'm joined today by James Witt, who's a mortgage broker, and we're going to talk about all things mortgages, getting the best rates, whether to go variable, whether to go fixed, and all the common mishaps that he sees. So welcome to the show, James.
Thank you, Lisa.
Let's get started with the basics. There's lots going on in the mortgage market at the moment. How do you think people can get organised? If their mortgage is coming up in the next 6 months or a year or so, what should they be doing?
Yeah, I think if people are thinking about moving and wish to buy, I think really a year in advance of that, you want to start to get your ducks together. So start looking at your credit file, start working out how much you can borrow, running a decision in principle with a lender, which is where you approach a lender. It's really a computer says yes, computer says no. They run a check on your credit file, use your income to work out how much you can borrow and whether they would accept you. And that kind of thing you really want to have a year in advance, because if there's any blemishes on your credit file, which you might not know about, it can take some time to repair that. And then obviously time goes by, your credit file will improve. And there's little things you can do.
What things do you see on the credit file? Like, I know we've seen where there's actually some fraudulent things on a credit file that take time to get off the report. Anything else that you can do to improve it?
The most common issue is phone providers, internet providers. If you've moved from one TV package to another, they've tried to take a payment, but you've already left, it's their fault, and they put a missed payment on your credit file. You're not aware of it because they wrote to your old address because you changed it because you moved. And you email them to ask them to take it off, and you'll get a response saying it will take us 30 working days to have that removed. And if you're in the middle of trying to buy somewhere and you've got a estate agent saying, well, where's your mortgage? That can put you under a lot of pressure and stress. And so getting that sorted out sooner rather than later is a huge benefit. But things you can do to improve your credit file, having a credit card, showing that you can pay it off in full every month. I'm not saying get a credit card and spend loads.
Go to Vegas.
Yeah, that would be fun, but no. But that's your evidencing to a lender that you've got a history of being able to repay credit, making sure you're on the electorate roll where you live, trying to give yourself that footprint from a credit perspective that you're a good proposition.
I know when I was doing my exams, one of the things to improve your credit rating was have a landline phone. Is that even a thing anymore? Like, does it help?
Well, I don't have a landline phone anymore, but I think having any kind of contractual credit agreement, so having your mobile phone bill and having that paid every month helps, rather than a pay-as-you-go that you buy for cash or as a one-off and no contractual agreement. Making sure that if there's two of you in the household, making sure that you're both on the British gas or the electric bill, you're both on the electoral roll at that property, and that all helps. You don't have to do amazing things on your credit file to be accepted. But it's really just doing the real basic things, electoral roll, having a couple of credit agreements, and making sure you've got no missed payments. And so you can go and download a copy of your credit file from Experian or Equifax. You can join them. They give you a 30-day free trial, cancel it afterwards, otherwise you'll start paying. But you can download a copy of your credit file to look through it. And mortgage advisors will help you with that if you want us to look through to see if there's any issues with it.
And how do you know if you should get a mortgage broker? Like, should everyone get one, or some people should just go straight to lenders?
Yeah, I think I would obviously make the argument that 99% of people should consult with a mortgage broker. Mm-hmm. We have access to the whole of the market, and we understand lenders' policy. Sure, you can go on a compare the mortgage and find out who's got the best rate at different loan to values. But then it's understanding which lender accepts your income, which lender will lend you more, the quirks around it. And the other benefit is, if lenders drop their interest rates, we'll be aware of that. Clients won't always be. Yeah. And then just the longevity of it. If someone went and got their own mortgage and took out a 5-year fix, for example, are they going to remember that in 5 years' time their deal's going to expire and they're going to be on top of planning and remortgaging and that's why you do find quite a lot of the mortgage population can be on the standard variable rate at 8%, 9%. I think it's somewhere between 25 and 30% of the mortgage population are on the standard variable rate.
So that's the rate you get when your mortgage deal is ended,
and you haven't done anything.
Yeah.
you put your head in the
That's
sand.
insane. 25
insane.
to 30%.
Yeah, it is insane.
I mean, it might make sense if you've got a teeny mortgage and you can pay it off really fast, but for everybody else, that's just good admin. Could save you money very easily.
Yeah, even if you've got a teeny mortgage, your lender will probably offer you a tracker deal with no arrangement fee, so you kind of just change to a cheaper deal at no cost. And it's very easy to do when it's with your existing lender, which, maybe we'll come on to that in a bit. But yeah, it's, so we try to make sure that clients don't don't go onto the standard variable rate. And the best thing that we can do is, 6, even 7 months in advance, is start looking at reserving deals early. I'm speaking to a client next week. 2 years ago, when the mortgage market was kind of chaos and rates were really going up, I found an email where we reserved the deal 6 months in advance and it was 4.5%. And then the last email was, she was like, oh my God, they're 6% now. I'm glad we reserved that 5 months ago because it's saving her tens of thousands.
Hindsight can be a wonderful thing, can't it? Because I bet at the time reserving a 4.5% probably felt really painful.
Yeah.
She would never have realised a few months later she'd be grateful for a 4.5%.
And there's no downside, because if it had come lower, we simply could have gone back and gone, we don't want that 4.5%. We want the 4.2 that's available now. Yeah. That's easy to change. So there literally is no downside to putting your foot in the door, reserving a deal early, maybe a little bit more admin, sending a few more pay slips and, over a 6-month period. But it can save you a lot of money.
And you're doing the admin. You're doing the hard graft of it.
We're doing the hard graft. They've got to download a pay slip from work or a tax document, or send us a new bank statement and stuff like that. But yeah, we're doing the hard yards for them, but it's to get them the best deal. And invariably we find that when we get clients the best deals, we get more referrals off of that, and that obviously helps our business. So you always want to do the best. And
how do you know? Well, if we go back to like 2008, 2009, 2010, rates were coming down. I was in a fixed. And then, God, I wish I'd fixed on a 10-year deal when rates were really, really low. How do you make that decision in today's climate of whether to fix or go variable?
Yeah. So, none of us are hedge fund traders, other than the hedge fund traders who normally get it wrong as well, because I know because I've got some of your clients. The market's changed quite a bit from 2010 anyway, where a lot of tracker deals now are 2-year trackers.
Yeah.
And they will have a loading rate on top of the Bank of England base rate, so where they are. So the Bank of England base rate today is 4.75. It might come lower next month, we don't know. And there will be a loading rate on top of that, depending on your loan to value, but call it 0.25%. So your all-in tracker deal would be 5%. I think the only benefit of really being on a tracker is flexibility, because most trackers will come without early repayment charges, and so that will be really helpful if you're planning to make a really big lump sum payment to reduce the debt, or you're planning to move in the coming months, or you've got some real uncertainty. Unless you feel adamantly strong that mortgage rates are going to drop quite aggressively over the coming months, because you can pick up a 2-year fix at 4.2, 4.3% at the moment. So that's, the difference between them two is nearly 0.75 of a percentage point, or 75 basis points. So you need the Bank of England base rate to drop quite a bit just to get to that rate. Then you need it to drop further for your average rate on the 2-year tracker to be equal to what the fix is. Now,
does that mean the market thinks that rates aren't going to come down as fast?
Well, the market swap, 2-year swap rates today have gone up a little bit, which is why we're telling people to come on, us quickly reserve these deals, because it takes lenders 2 or 3 weeks later to reprice. So that's why we're saying to people to grab these deals. The market anticipates that rates are going to come lower, for sure. And that's why you can pick up, 2-year fixes around, much lower than where the base rate is. But the lenders are also going to charge you this loading rate on top of where the base rate is. And so it may be that the tracker ends up kind of equaling where the 2-year fix is, but you're also going to have that stress all the time of every time there's a Bank of England rate call, you're going to be looking at it, worrying about it. And I'm not sure people would want to continually look at that. I don't think it's an amazing bet to go on the tracker right now, in right now circumstances, because I feel you're going to be paying a premium for a period of time, and you'll need that rate to come notably lower and quickly.
There is an element of worry, isn't there?
Yeah.
At least with a fixed, And if you can afford it, it's not changing. It's very predictable.
And that's where I think people should sometimes try and take out the gambling what rates are going to do and more concentrate on what's most suitable for them. Because, you've obviously got a 5-year fix, and a 5-year fix will be a little bit cheaper than a 2-year fix at the moment, because it is expected that rates will come a little bit lower in time, although I'd say there's been quite a big shift in longer dated debt over the last month. We were looking this morning, 10-year, debt over 10 years has risen quite a lot, the cost of that debt. And so the market is now anticipating that, rates are going to come down a little bit, but they're going to remain elevated for a much longer period of time, whereas 2 years and 5-year money is kind of still similar. They still expect rates to come a little bit lower in the short term, but then kind of remain where it is. 5-year fixed rates are a little bit cheaper. They give people much more certainty. They know what they're paying. They don't have to worry about it. A 2-year fix is a little bit more, you've got a better attitude to risk. You fancy having that punt that rates might come lower. I think the tracker is almost the extreme of that you're really gambling where rates go. And that might be absolutely fine for some people. It might be suitable if you're planning to move or you might want to make a really big overpayment. But most of the mortgage market is really looking at 2-year fixes and 5-year fixes and where the value is there. Again, I can't say that, unlike in 2010, people locked in at 4.5% and 3 years later rates were down at 2%. Or you can always pay an early repayment charge to break out of that deal as well. There are penalties, but if you can recoup that penalty and some, it can make sense to do that. So you're not completely stuck in forever and a day. But most people will be looking, thinking of it around budgetary certainty, knowing what you're paying, build the rest of your financial planning around that.
So being organised, getting the right deal for you, these are ways for, good financial planning, but getting the best rate. What other things can we do to get the best rate? I know there's sort of hurdle rates, aren't there?
Yeah, so tiering, your best loan to value. So the value of your mortgage relative to the value of your property is your loan to value. And that's how lenders price their mortgage products. If you've got a ginormous mortgage, if you've got a £950,000 mortgage on £1 million property, your interest rate's going to be huge because there's not much equity in that property, and that's very risky for the lender. The best loan to value is really when you've got on £1 million property a £600,000 or less, a 60% loan to value. That's where you'll get the best. Reducing your debt any further is obviously great. You'll have a lower mortgage and but it won't improve your interest rate. So it's a case of trying to get you to the right loan to value. Sub 75% loan to value is a great place to be. Not quite as good as 60, but they're very, very close.
Okay.
Above 75% loan to value, there is a bit of a jump on rates. And depending on the value of your property is not what you think or an estate agent thinks, it's what the bank's valuer thinks. And they're always going to be a little bit more negative. And that's sometimes why we might do 2 or 3 applications with 2 or 3 different lenders, with 2 or 3 different surveyors, and you might get different outcomes because it's not an exact science. And so one surveyor might come and say, your property's worth 300, another one might say 350. And so you might benefit from that better valuation by falling into a better tiering of products. Once you know what kind of valuations you've got, maybe then considering paying down the mortgage a little bit, if it drops you into a better tiering of products, can save you a lot of money on that interest rate, especially if you're taking a 5-year fix. And
different lenders are going to might value it differently, but they're also going to look at you differently, aren't they? They've all got different policies. What is the rough rule of thumb of what they'll say you can borrow, for example?
Yeah, most high street lenders will, for an employed person, lend between 4.5 and 5 times their income at a maximum. That's not taking into account loads of outgoings. If you've got 2 Range Rovers on the front that's costing you £1,500, that's probably just the insurance, but it costing you £1,500 a month to cover that, they're not going to lend you as much. But 4.5, 5 times your income. The big difference is when it comes to anything outside of vanilla salary. Bonus income, lenders can look very differently at bonus income. Most lenders require a 2-year track record. Some lenders will use that as being 50% of salary. Some can go up to it being 75, 80% of salary. Self-employed income can be looked at very differently as well. Some lenders can use 1 year of accounts, especially if you're a relatively new business. Some lenders want to see a couple of lenders even a 3-year track record. Depending how you're structured, sole trader, limited company, it can be very different. If you're a contractor, lenders can look really differently there as well. Some lenders for a limited company can say, well, we'll look at what salary you're taking and what net profit you're leaving within the business every year, i.e. what you could have taken as a dividend. Other lenders will say, no, we're only looking at what you've taken as a salary and dividend, and that's it, only your taxable income. Yeah. So self-employed can be quite different for different lenders. Most of the high street for employed people, it's quite vanilla. Banks can lend a little bit more. Building societies, you tend to find are less aggressive in how much they're willing to lend. So, unfortunately, Nationwide won't always lend as much as a Santander, for example. And so, and it can even differ how much you borrow depending on what product you take. So some lenders will lend you more on a 5-year fix.
Oh, is that right?
Because you've got more certainty, they know what you're paying, 5 years of guaranteed rate. And on a 25-year term, you'll have 20 years of uncertainty. Yeah. If you only took a 2-year fix, you've got to review that rate in 2 years, so there's some uncertainty there. And you've got 23 years of uncertainty. So they stress it at a little bit of a higher rate in the background. So all mortgages that you apply for, if you're applying for a 4.5% deal, in the background, the lender's making sure that's affordable on 7.5%, 8%, because rates could go there. Yeah. There's no way of knowing where rates are going to be in 3 or 4 years' time. So lenders will always stress it at a high rate, but that stress rate will be lowered on a 5-year fix than it will on a 2 for some banks.
And things like school fees, childcare costs, they're all going to really go against you on that calculation, aren't they?
Yeah, they are. In some instances, if your income's really huge, if you're fortunate enough and you've got school fees, it might not impact it because the lender might say, well, there's enough spare net income there from that big income, so it doesn't really impact it. But yes, school fees can be large. Childcare costs can be huge. Even though it's only for a period of time, 2-3 years, and the government's had made some changes on help with that. It can impact. Yeah, it can for sure impact how much you can borrow.
And I know when I've made business changes, so whether that's like setting up my company on my own or choosing when we moved house, it really was all aligned to getting me, the accounts, the accountant and you all in an agreement on when is the right day to make any really big lifestyle changes.
Yeah. So technically now, as of today, you don't have to have completed your 2024 tax returns. Yeah. But if you come and want to get a mortgage and you're self-employed, you have to have had it done. Back in October, you needed to have it done. Because the most recent accounts for someone would be 2023, April 23, and the lender would look at that and go, that's too long ago for me to get comfortable with what your income is now. So you need to do your accounts early. So yes, if you're self-employed, you might want to get your accounts done and be a bit more proactive than leaving it to the last minute, which lots of people do, leave it till the end of January. Guilty to that myself once or twice. And equally, if you feel that your most recent year's income is better, which for a lot of people it can be, your business grows over time, we want to have a better number to go to a lender and ask how much we can borrow.
And last question, I know some lenders' sort of marketing technique is we give our best deals to our existing customers. Is that true? So therefore, should you not shop around? When do you know to shop around and when not to?
I think you should always shop around, really, if you can. I think you should always look and compare what your existing lender is offering you compared to what you can get elsewhere. And I think that shop around needs to remain in place for the 6-month period. With the mortgage charter, Martin Lewis was great. He pushed the government to allow people to reserve deals, 6 months in advance. Lots of lenders have rowed back on that now, and they've ditched that. And so most lenders are back to 3 months. Barclays gone back to 90 days. Halifax is 3 months. Nationwide is 4 months. NatWest is 4 months. Lots of lenders have rowed back on that. But you can apply for a remortgage 6 months in advance, potentially even 7 months in advance. And so you may benefit, even if your existing lender is offering you the best rate today, you might not be able to have that because you're too far out. Yeah. But we can approach another lender that maybe it's a couple of basis points more expensive. You might be able to reserve that deal now. And if over the couple of months interest rates go up, even though your existing lender might be offering you a great rate then, well, you got better 2 months ago. Yeah. And so I think it's always worth considering what you can get elsewhere. I fully appreciate, though, that staying with your existing lender, if they're offering you a great deal, is very easy.
Yeah, sometimes you just do it on the app, can't you?
Yeah. Again, I would say do it for a mortgage broker, and the benefit there, obviously we get paid a commission from the lender for that, but the benefit is that if interest rates drop during that 3-4 month window, we'll know about it. Yeah. unless you're going to look on that lender's website every day or once a week to check over a 3-month period, we'll know, we'll go back, we'll improve on that deal for you up until completion or until we're allowed to.
And is there a financial downside? So you're getting a commission, but is that just already worked out in the percentage of the interest
You'll get exactly the same deal through lenders. Do not dual price, other than NatWest, who offer better deals, or used to offer better deals through brokers than they would for people going direct,
because they want the other way around.
Yeah, a lot of banks want to incentivize people to use intermediaries, brokers, because they don't want to have as many branches open. They don't want to
take the risk, maybe.
Yeah. We've given the advice on what deal to take. So there's no, they're not. Banks won't advise you if you call up a bank and say, "These are my circumstances. What's the best deal?" They're not going to advise you and say, "Oh, I think you should have a 2-year fix," or they're never going to advise you, "Hey, if you pay down that mortgage a couple of grand, you're moved into a better tiering of products, which will save you £10,000 over a couple of years." They won't do that. They're not allowed to advise. We can, and also we can keep a watch on it to see whether that rate improves during that window. And rates are jumping up and down a little bit. I wouldn't say it's extremely volatile, but they are moving. And so to have someone that can improve on a deal, we like sending clients emails going, "Oh, we've ditched that deal and reserved this deal. It's going to save you X amount over 2 or 5 years." They're nice emails for us to send.
Good part of the job.
Yeah, but staying with the same lender, you're not having any underwriting, you don't have to get the pay slips, you're not going to have a surveyor. And the big part is you're not going to have a solicitor in place to remove the legal charge, which is paid for by the bank, to remove the legal charge of whoever your current lender is to put it on the new lender. So there is a little bit of admin, but if it saves you a lot of money, it can well be worth remortgaging from one lender to another. Yeah. When you stay with your existing lender as well, everything stays the same. It's just the interest rate changing. So you're not changing the structure of your mortgage. It's very hard to borrow more funds with that same lender when changing, because then they will have to underwrite the whole mortgage at the same time. And so every scenario is different. It has been times where someone had come and they've got quite a small mortgage, and we would say to them, "Look, you don't need to use me because I might have to charge you a fee because I get paid so little from the lender. But this is really what you want to do," and so just approach the lender yourself. You're
good like that. I always do find you tell clients, if it's right to go direct, go direct.
Yeah, and on the odd occasion it is. It really is. Otherwise we have to charge fees, and we don't want to really have to charge someone a fee to do something that they can do themselves. Yeah. And
then one thing, sort of going through various different guises of being self-employed, company director, as I am now. One technique that you helped me with was we put the term of the mortgage to the maximum I would be reasonably happy to retire at. It's later than I'd like. And then that means the mortgage payments I have to pay are reasonably low. And then we worked out together what the ideal term would be to have that mortgage paid, and then I overpay on a monthly basis. So it's like, from my point of view, my mortgage has got that shorter term, but if something went wrong financially, then I really like that safety net that you've put in the strategy. That means I can just automatically lower my payment back to that lowest amount.
Yeah, I've always enjoyed doing that, and I think it helps because I'm a mortgage broker that works with financial planners, great financial planners, and I think that's an easier option or a better option to take when you are engaging with a financial planner, because then they can highlight these things to you. But extending the term, giving yourself that lowest committed monthly payment, because you have found that people, instead of having a 35-year term, went for a 25-year term, 3 years ago, but their deal's coming to an end now. That 1.5% deal's coming to an end, and now it's 4.5%, and they're like, "Oh wow, that's
can't quite afford it."
Yeah, and so doing a product transfer, so staying with the same lender in that scenario, isn't suitable, because so then we remortgage them to another lender and kick that term out to bring that jump in payment down a little bit. And every lender will offer you an overpayment facility on a fixed rate mortgage. The lowest will be 10% of your current balance every year. Some lenders every calendar year, sometimes every year of an anniversary of when you start. Some lenders it's 10% of the original amount, some lenders it's 20%. So you've got loads of flexibility to overpay. And so you get a pay rise, great, start overpaying a little bit more. One phone call, one direct debit to your lender, leave it running, it's very easy. Some clients can be quite, bonus, commission orientated. So for them, it's more a case of annual bonuses come in, I'm going to call up and make a £5,000 overpayment to bring that down, and I like doing that every year.
Yeah.
But doing that in conversation with you around what are my other things I could do with that money, pensions, ISAs, all the other things, like that's where I think that it's much better to be doing that if you're engaging with a financial planner.
Yeah. And also you might mean to do that overpayment but never actually do it.
That is true. That is true. But equally, lots of people, don't move once in their life and want to stay in that house until they're 80, 90. Lots of people when they're getting towards their 70s will want to downsize. And so do you need to guarantee that your whole debt is completely paid off by the end of the term? Not always. And so people will have some people will have a larger family home and realise that that's too much for them to maintain, and then they want to downsize. And so I think that equally works as well within that, you don't always need to guarantee it's completely paid off.
A question I get all the time is, what about other types of income? So often the question is about spousal maintenance. That's not money you're actually earning yourself, but it's being given to you after a divorce. Can that count?
Yeah, so very much like the self-employed income, every lender's a little bit different. And lenders will use that income. Some lenders will use that income. Some lenders will require there to be, the court documents confirming what that monthly income is that you're receiving. Some lenders will want to see 3 months bank statements to show that you're using it, but they can absolutely use it. Some lenders will only use it if you've also got another form of income. So you've got an employed job or you're self-employed, but there are 1 or 2 lenders that will use that income exclusively. And again, it's a case of every lender's a little bit different in how they work. Some of the less high street lenders won't use that, but plenty of the really good lenders will use that and use 100% of that for affordability. And even if you're only receiving that for, another 8-10 years maybe, due to the kids' ages and so on and so forth, lenders will still use that over a 25-30 year term.
Right.
Because their argument is, well, when you're not having to look after the kids, you can go back into more full-time work and earn more funds exclusively. But it's only certain lenders, and so that's kind of where you need to know where to go for that.
Well, thanks, James. That was so helpful and jam-packed with tips, so thank you.
Pleasure.